Maybe for the first time in my life, I want to short the Canadian real estate market, more particularly the surrounding Toronto market that is highly fixated on commercial and development. I think they are about to get absolutely wrecked, and we're going to go over some data that explains why I'm feeling this way, and then we're going to take a look at different ways of going about this, at which I might need your help because this isn't exactly the easiest task to pull off. I'm not like Michael Burry. This isn't the 2008 financial crisis, but damn, we are about to see something we've never seen in the Canadian real estate market, largely driven by the pandemic. So first and foremost, let's talk about the data coming from the Toronto Real Estate Board, starting with the residential stats. The total residential transactions year over year are now down 38.8%. No longer are people taking a for sold sign the day of listing, shoveling it in the ground, sight unseen, no inspections, no more like bidding wars galore. That is coming to an inevitable end. And like I said, the people that it hits the most are the most speculative aspect of the Canadian real estate market. Seasonally adjusted month over month is down 9.3%. Now, the average selling price, which makes people feel a little bit more confident in the real estate market, are still up 9.4% year over year, but seasonally month over month are down 3.1%. And in my own personal municipality, I have seen corrections right now in real estate upwards of 30%, and those numbers have not come into full fruition across the broader market, but I think month over month these numbers are going to start looking a lot worse. Now, total new listings are up by 0.5%, but percentage of sales to new listing ratios are down 25%. This means people are going to negotiate in a higher interest raising environment. People are less willing to speculate on the future, which means they're less likely to buy a pre-construction or pre-build property that's going to take another couple years to come onto the market. And you have to think, in this inflation market, we've seen pre-construction builders actually raise the closing price of homes on buyers because it costs more to get wood, it's cost more to get construction workers, and they tried to pass that on to the end user so they could get stuck with a massive bill and people walking away. And yeah, they might get charged a walking away fee, but I guarantee that fee might be a lot less than the value of that property they're looking at in this current environment. Now, property days on the market, guys, year over year have gone up 20%, which is very fascinating. And basically listing days on the market have gone up 9.1%. These are going to continue to go up month over month. But let's get into some of the other stats, like commercial stats. And this is where you got to be a little bit more careful. All leasing activity, right? It's kind of crazy to think the leasing activity year over year is now down 25%. All sales activity is down 21.7%. Average industrial lease rate, luckily this is up 28.6%. Average office lease rate, when offices, obviously when people are trying to work from home, one of the hardest hit aspects of the commercial real estate market, down 2% over this time last year. Now, the condominium sales, another really interesting one. Total condo apartment sales are now down 15.6% over last year. Year over year, the average selling price is still up 22.4%. So very intriguing. Again, I think these numbers are going to start to shift in the coming months because if there's just less demand in the market, inevitably that means more negotiations for people that are desperate to get out of deals. Total new listings, guys, are still up 0.3%. Sales to new listing ratios down 14%, and days on the market, really intriguing here because year over year are down 47.8%. So, I mean, this is a little confusing because that means that there's a lot of negotiation, a lot of people still buying condos, right? Now, the condominium rental stats, this is interesting. Total apartment rentals year over year are down 23.2%. Average bedroom apartment rents are still up 17.9%. And the total new listings of condos here, this is crazy, right? Down 42.6% on condominiums. A little bit wild. This is a fascinating, just these stats are just all over the board here. So let's talk about shorting these markets, because a lot of people, I've been watching YouTubers right now, they have been taking on basically the easiest way to short real estate in the US, which is by shorting the actual REITs, real estate investment trust, because they're publicly traded. You can personally short them through options, or you can do it through these kind of inverse ETFs. And this is the most fascinating one. I'm saying this correctly, the Direxion Daily Real Estate Bear 3X shares. This is a triple leveraged short ETF. And again, this thing is done miserably since its inception, but year to date is actually outperforming the market. And I don't really understand the broader market view because I think income is good. I think, the stress test on mortgages are a lot more extreme than they were 10 years ago. So I'm not expecting like some kind of full-fledged real estate correction. And I would rather fixate on Toronto and the surrounding Toronto area because they're growth-based markets, and speculation and growth right now is getting devastated. So you can go about this a few ways. There's like the pro short real estate ETF here for the US. There's this one, the ultra short real estate ETF. All of these are doing fabulous this year, by the way. But going a little bit farther, in Canada specifically, because we don't have a direct way of shorting like the US here with these specific stocks, you kind of have to do this a little bit more intuitively and pick specific investments. And Bridge Real Estate Services is a company that is highly focused on basically licensing fees from realtors across the provinces. And if you think real estate volume is going to dry up, there's less likelihoods of people making a higher amount of income, which the stock has done relatively well. And again, year to date is kind of getting devastated here. So this could be one way of going about a short. I mean, you could short the big REITs, but again, this comes with more risk because I think through the March 2020 crash, a lot of the REITs that I currently hold, like RioCan or SmartCentre, some of these companies have actually done a really good job at fundamentally fixing their balance sheet by paying down debt, getting cash available so they can weather these kind of storms, which make them a little scary to short. Now, you could go directly into the mortgage market with MCAM Mortgage Corporation here, guys. These mortgage companies, all they do for a living and the only way they make money and pay these really high dividend yields is specifically off getting mortgages, right? And if the markets start to dry up, and these are typically higher risk mortgages because for them to pay you a 7.96%, typically you're looking at people that are on second mortgages, higher leveraged in real estate, and those are the people you kind of got to worry about the most, because in the last 3 months, if these people bought a property for over $1 million, which again, the average price of a property in Ontario now is over $1 million, and we see a full-fledged 15, 20, 30% correction, I mean, it's a pretty insane number to know that you can't sell that property to buy yourself out of the mortgage when you're leveraged anywhere from 10% or above, right? Which is crazy to think about. Now, I'm not the first person to consider this. I mean, I was been reading through forums and there's not a lot of new information on how to short the Canadian real estate market. And I just think it's funny because these posts were from like almost 10 years ago and everybody was telling them not to short the real estate market. And they were showing like all these stats. I mean, look at this. This is from 2013 when it was hitting all-time highs into 2016. And yeah, I wouldn't have really considered shorting it then, but like I said, I think we're in different times right now, and I'm dealing with stuff personally in my own life that is extremely frustrating. That makes it seem more logical to short. Obviously, with its own, it comes with its own risk. But yeah, it's just really weird, right? So I'm looking up all these construction homes right now, these publicly traded construction companies, and I'm gonna start doing some due diligence on them and try and figure out what ones would be the most appropriate to maybe take some short bets against without taking on like an exuberated amount of risk. Because man, I just can't see how the construction industry is not terrified right now in this interest raising environment, these massive corrections after trying to pre-sell these homes at ridiculously high prices, and everyone's like, oh, they have contracts, they're locked in, you can't walk away from that. You are a moron. Anybody can walk away from anything. And again, if we're seeing these residential areas see the largest correction in real estate, like I said, why, if it's easier to walk away from a contract and lose, say, $50,000 than walk into a home that has lost $300,000, $400,000, or $500,000 in value, you start realizing that you'd rather screw your whole credit up than lose $500,000. And I just, like I said, this is some weird stuff going on right now, and it chills me to my bones. So it's going to be neat to see how this unfolds. And I want to pass the question off to you. How do you guys think you should go about shorting the Canadian real estate market? If I do pull this off, it'll make for one hell of an entertaining video down the road, whether it works out or not. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.